next section of Learning Objective 2, is a listing of common temporary book tax differences and a description of each one. And then with this dividends area, this starts the discussion in this learning objective of a bunch of different, I don't know, maybe more complicated items that create book tax differences. And for the most part, I'm going to let you read through these. I'm kind of going to just scroll through them, give you some commentary where I think it's necessary. For dividends, for book purposes, you'll notice that depending on how much of the company is owned by the shareholder, that will impact how much income for book purposes gets recognized. For tax purposes, just the amount of the dividend goes into taxable income. So you'll compute a difference using those two methods. Goodwill, when a company buys another company, a lot of times some of the purchase price will be allocated to goodwill. For tax purposes, that's deductible over 15 years as tax amortization. For book purposes, you don't get to amortize goodwill. You simply write it down if you calculate the value and find that it's impaired. We don't have to worry about how to do that, but for book purposes, that's how they calculate any expense related to goodwill. So you've got a difference there. Some corporation-specific deductions. Stock options are not something that's interesting reading if you'd like to read through that, but it's not something that I'm going to get into asking you questions about or testing you on. So that's a pretty big chunk. Net capital losses are an issue where book tax differences can arise. Net capital losses are going to be losses on the books. Whatever the amount is, they'll show up as the loss. But for tax purposes, you don't get to deduct net capital losses, that is, capital losses in excess of capital gains. You don't get to deduct them in the year they're generated. Instead, you've got to carry them back or carry them forward to periods where there were capital gains. And you can only deduct those losses in periods where there's capital gains. So that creates a book tax difference. Net operating losses is a concept that doesn't exist really for book purposes. For tax purposes, this is a provision that Congress has enacted where companies can kind of smooth out their tax liability by allowing companies to carry losses back 2 years or forward 20 years to offset taxable income and tax that they may have paid in those years. So you can read all about net operating losses right here and how income gets carried back. That's a good example. Charitable contributions. For book purposes, they're simply an expense. Whatever amount is donated to charity, that amount is an expense. But for tax purposes, they're limited to 10% of taxable income. That taxable income is a little bit weird in how it's calculated. It's 10% of taxable income without regard to any charitable contribution deduction. But it's limited nonetheless. So you can have a book tax difference in the amount of the deduction, in the amount of this item. So you can read through charitable contribution deductions. Also, it should be noted that charitable contributions can be deducted in a year as long as the board of directors approves the payment and it's actually made within 2.5 months after year end. So you don't have to make the charitable contribution in the year of deduction. It can be just guaranteed by the board and you still get the deduction that year. So this is a kind of a long section on charitable contributions. Dividend received deduction. Remember, this is where corporate shareholders own parts of another corporation, so they get dividends from the corporation. And as I think we talked about briefly in Chapter 15, these amounts are not going to be fully taxable to the corporate shareholder. They will get a dividend received deduction depending on how much of the corporation stock they own. So you'll have a book tax difference that results there. This is going to be a permanent difference because there's no such deduction like this for book purposes.